Thank you everyone for joining us this afternoon for the CPD qualifying seminar. So let's get into it. So my name's Will Rogers, and I'm delighted to be joined here today by Richard de Lisle. Richard is the fund manager of the Lisle America Fund. Just before we get into the presentation, I've just got to clear up some housekeeping. So this webinar is for professional investors and eligible counterparties only. Any views expressed in this communication are those of the fund manager and are subject to change without notice. They are not necessarily the views of de Lisle Partners and do not constitute investment advice. Your capital is at risk. Past performance is not a guide to future performance, and the value of an investment and income from it can go down as well as up. So any questions that anyone has throughout, please just drop them in the little Q&A box at the bottom. We should have some time at the end for some questions. Any that we don't have a chance to get to, I'll make sure that I or Richard get back to you. So with that bit of housekeeping done, just before I hand over to Richard, I'm just going to sort of frame our discussion today. So Richard is a veteran of US equities with over 40 years experience, and he's a fund manager of the de Lisle America Fund. It was launched in 2010. It's a small and micro cap fund investing in the value end of the US market. Out of the entire fund universe on FE TrustNet, containing 4,234 funds, Richard's fund is currently 6th as of this morning over a 1-year time frame. He's also achieved an impressive 16.7% annualized performance since the launch of his fund in 2010. I think it is particularly impressive given that arguably value hasn't been, it's been lagging growth really since the last financial crisis, and we'll get into that a bit more later in the presentation. But now the investment headwinds are turning into tailwinds for sort of US small cap value. It's teed up to be quite exciting few years for Richard's fund. So if we just look a little bit at this agenda, I'll give an introduction to Richard, who'll be answering sort of some questions today as we go through the slide deck. We'll split the topic of this webinar into 4 main sections. So firstly, we'll look at why the US, then why small cap, why value, and why now. We'll put a few points together in a bit of a summary, and then we'll have some questions at the end. So hopefully the agenda will give today a bit of a full overview of the US small cap value and why we are so confident in the sector going forward. So Richard spent 20 years working in the city, culminating in 7 years as the managing director of Dean Witter's 6 international offices, before leaving the city when Dean Witter merged with Morgan Stanley in 1997. Richard, good afternoon. Thank you so much for joining us. Perhaps you could give a sort of short introduction to yourself and how you came to run a US focused fund today.
Hello, Will. Thank you. And thank you for doing all that work before me. So I've been in stock markets all my life because as a teenager, back in 1970, and going into the early 70s financial crash, my father lost all his money, which had me hoiked out of a very minor public school into the local state school. And I wanted to understand this mystery that had brought such unhappiness and calamity. So that's what I focused on for the rest of my life. At college, I collected up my fellow students' grant checks and invested them in the market, and that's what I was focused on there. And I've been doing it really as a pleasure ever since. I fell into the American market basically because Merrill Lynch would have me, but also because I couldn't get up in the morning and the hours suited. I was very lucky. It's by far the most stimulating market. Everything else takes its lead from it. And so I wouldn't change it, and I have therefore not changed it. I've had many opportunities to change it as other places come and go, other places get exciting, but I've never wanted to be anywhere else. So so that's where I've been for the last 40 years.
Yeah, thank you, Richard. So if we sort of dive in then, we'll start the US market. So slide here just shows some sort of basic information on the US stock market. There's roughly 5,500 companies in the US. 63% of those deemed to be small cap or below. Just for some context, in the UK, there's only about 2,000 companies that are registered in the UK. So clearly, the US is very investable with so many companies. Richard, why do you think the US is the best stock market for long-term returns?
Well, first of all, it is the best, Will, and I'm actually going to use a prop here. Don't like doing this, but this it was discovered to be the best. I don't know if you can see this. About 20 years ago, when this book was published, which was 100-year data, it's brought up to date every year. 100-year data about which is the best market, and the US is the best major market. So as a point of fact, it is, and so then we can start making excuses as to why. The reason why is reasonably simple, which is it's got the best corporate governance. The SEC forces the biggest disclosures. And the other thing you need for a good performing stock market is the rule of law, and it has that as well. And therefore, with its culture, capitalist entrepreneurial culture, that's all you need to be the best market. Best major market. Going back, that used to surprise people. It doesn't so much now because of the way the market, big cap stocks have done well in the last 15 years or so. But it's quite a statement when the biggest is also the best.
Certainly. So moving on, when looking to generate future returns from stock market investments, I think many investors look towards countries with strong forecasted economic growth, with the belief that there's a correlation between economic growth and stock market returns. Richard, what's your take on that?
Well, economic growth doesn't correlate so well with stock market returns. We can all think of plenty of examples of strong economies where the stock market hasn't done well. You come up immediately with places like South Korea, Japan, now we have China. Not many people have made much money investing in China, despite its strong growth. And it all comes down to whether the corporations are working for the shareholders or not. So in South Korea, we've got the chaebols, and in Japan, the cross holdings. And that has dissipated the flow of money going down to earnings per share over time. So it's just to say it's not a growth thing. And what we're looking at here is another representation of the US doing better. This time it's a shorter term chart. It's just 30 years or so. And that does show the big stocks pulling away in the last 10 years. But again, it's counterintuitive. People think, I must go to somewhere where they've earning. But we've seen it for years. In the 1980s, people wanted to go to Southeast Asia because places like Thailand or Singapore were growing fast. Singapore's never worked for investors, not very well. The growth has been there, though. Yeah,
that's a great example. If I move on to just this slide, we'll just touch on it quickly. I mean, this chart, it goes back to basics, shows us the percentage split of the total global equity market by country. Clearly, the US cannot be ignored here. It's a staggering chart. Richard, what does this mean?
Well, it means the US is at the top end of its range. It's incredible, isn't it, that this country of 330 million people is 56% of the stock market of a world of what, 7.8 billion people or whatever. Doesn't make sense. In fact, the proportionate share of the US has oscillated over time between 30 and 50. People will be amazed, I think, now that in 1989, at the end of 1989, Japan hit 50% at their peak. But the US doesn't go down to 7%. The US oscillates between 30 and where it is now. It's at the top end of its range. Is that a problem for us? No, not at all. All that's telling you is that the massive capitalizations in the big growth stocks have done this. If you take those out, the US is back in its normal range. So what all it's telling us is that the US has become the home of technology, and it's been the home of these huge trillion-dollar corporations, and that's distorting its market share. Again, it's why does this happen? Why has all the technology happened there? And it's the reasons we've already talked about. Why can't anyone else get big technology? And you see it right now. I mean, everyone thought, well, great idea to invest in the Chinese tech companies. They've got a bigger market, get into Alibaba and Tencent and so on. And they've all been great for a while. And now that same problem of government coming in again and putting a question mark about how much they would be allowed to grow going forward. So basically, what I'm saying, Will, is it's not telling us too much in terms of investment propositions.
Yes. And just for some context, the median market cap of your fund is $360 million. Is that right? So
yes,
way down the market cap scale. Yeah, exactly.
Yeah.
So
and we're mean is about 400, median is 360, and so
yeah. So if we move on now to look at small caps, this chart here, it shows, and it's a logarithmic scale, so it kind of takes some of the scale away from it visually. But if you were to invest $1 into small cap stocks in 1926, you've been left with almost $37,000 today, versus only sort of $7,300 for larger stocks there. I suppose, Richard, what's your take on the long-term performance of small cap companies, and what opportunities are there?
Well, this is Wall Street over 100 years. Small stocks, as this shows, are better. And again, this was something that we knew in the marketplace, but it wasn't proven until an academic paper by Fama and French came out in 1990, the purpose of which was to prove to their mate, the economist Paul Samuelson, that markets were efficient. And instead they managed to prove the opposite, that small caps were better. Everything that has come out since has really picked up off that discovery. I mean, that was the start of quantitative analysis, because if small caps are better, the next question is, what type of small caps? What industry should those small caps be in? How do we define a small cap? And he just raises loads and loads of questions, which I'm now going to use my second and last prop, which Wall Street, of course, has then put its most powerful computers to discover all the solutions to that. And by 2005, this sort of book was coming out by O'Shaughnessy, great quantitative analyst, chopping and dicing every type of aspect of what is small and so on, and what is value and goodness knows what, to find the perfect future prediction of performance. But here we're just looking at the overall thing. Let's throw a dart at small caps, see what happens, and yes, it's good. This chart is important for other reasons that we'll get onto later, but I just say now, let's note that in the 1930s, the small stocks underperform, and that's really relevant to a period we've just left.
Yeah.
The reason why this happens, I mean, okay, once we know the fact, small stocks are better, people make up stories. Why are small stocks better? Well, of course, they're more flexible, they can respond to things quickly, they not tied down by corporate overhead. You don't have to, have various levels of committee before you put another size packet of biscuits. You just don't have the structure. And in America, of course, you've got the wonderful entrepreneurial spirit, whereas everyone wants to create their own small companies. That last point is actually relevant to our portfolio, because we've got types of small cap stocks that don't exist in other markets. And that's due to that entrepreneurial spirit of wanting to own your own business.
Thank you. So if we move on, this chart here, it really demonstrates the varying definitions of small caps between the US and the UK. I think there's, from people I speak to, and there's a misconception that you say small cap, it's people think it's the same size regardless of which stock market you look at. It's not the case. you can see here that the size of US small caps is considerably larger than the UK. So I suppose, Richard, if I were to ask, why is the US the best place for small caps? What would you say?
Well, it's a bigger place. Again, it's coming back to the culture. Because everything's bigger in the States and the funds are bigger, their definition of what is small cap is bigger. So that can get to some misleading. That doesn't translate so well, because if we say we're in small caps, people maybe don't quite understand. So I think here we're looking at an issue of definition. I mean, if you're a US small cap fund running billions, you quite simply have to have the definition up at the level where you've got it, Will, around about $1 billion for a small cap. Otherwise, you can't run your fund. The small caps are uninvestable. So there's that definition thing. But on top of that, there is the fact that even if we were doing this on a level playing field and saying that US small caps were the same size as UK small caps on a definition basis, there just would be loads more of them because of the culture. The reason this graph matters goes back to my second prop, which is one of the things that these guys found was that it's the smaller the better for the outperformance. It's almost like a continuum, if you like, of better performance the smaller it is. So while it might suit US small cap fund managers to define the beast as larger than you might think, it actually suits in getting the performance to get as small as possible, which is where I think we for instance, will have a competitive advantage with our average market cap being smaller than anyone else's. So I'm fortunate in that I don't have to do as well as everyone else, and the results are better. You know, I don't have to be as clever because I've got a tailwind. That's what we do. We try and find a tailwind in various ways, and that's one of them, the size way. And
I suppose, could you touch on analyst coverage as well then? You know, but the difference between the US and the UK, it's a smaller pond to fish from in the UK, and I think there's more coverage, there's less opportunity for take advantage of sort of pricing inefficiencies. Could you just touch on that?
Well, quite simply, Wall Street covers what Wall Street can make money out of. So therefore, it doesn't really reach down into our world. So because there's just no money in many of these small caps, even if you're trying to merge them together. So by Wall Street standards, many of these are not covered. Many of our stocks, for instance, we're the only institutional investor, and they have no coverage. So I think that's probably different from the UK, where you know everything is trolled endlessly. Everyone knows what all the companies are. That's not so in the States. That is an advantage, of course. That's a big advantage. You get the boost as the companies get bigger and they get picked up. They get picked up by the very many different indices. You know, as they grow, they suddenly go up as some other index incorporates them, and everyone bundles in, and we bundle out because once it's in that index, it's not a club that we want to be in anymore.
Yeah.
So there's various little nuances of taking advantage of the way they go up the scale.
Yeah, fantastic. I'm just going to move on to this slide here. It's a chart which shows the performance over 1 year from the 31st of March 2020. So really not far off to the day, the bottom of the market, thereabouts, and it's the fund, Richard's Fund to Latin America Fund, and the S&P 500, and then a blend, equally weighted blend of the top 7 companies of the S&P. We put in there the sort of medium market caps there just for some scale, but could you run us through this one, Richard? So there's 2 sort of notable bits on here I know we've discussed before in September and November. Could you just run us through it, please?
Yeah, well, as you say, Will, this really takes it from the bottom to where we are now. So the first thing that happened in lockdown is we all realized that the only place to be was in the big tech, because we were all locked down at home, and so the stocks that we know as the famous lockdown stocks like Zoom and Netflix and Surge and of course all these, your big seven, they surge as well. So off they go like and nothing and everything else, because there's no growth, you know, is not so good. We had quite a big investment by a very wise investor that invested right at the end of March. So we were suddenly 7% liquid. I didn't know what to do with it. So I just banged a lot in Amazon, because it was about the only time I've ever been interested in these things, but it just had to work. And we sold it at the beginning of September, on the day it peaked, actually, because there was a big flag that was like, these stocks have just peaked, which is when SoftBank was discovered to have not been content with making so much money with the stocks going up. They bought loads of options in them as well. So suddenly you had this idea that had to all unwind in the same way that hedge fund has just unwound a few weeks ago. So suddenly it was like a bell going off. So we made 65% in whatever that was, 5 months. The counterfactual, which is really, you know, because people think that's wonderful. Wow, you know, you just took the biggest surge in Amazon over the last few years. It seems wonderful. The counterfactual is, had we put it in, just dissipated it all over our fund, we'd have made the same return, which is fascinating. In that, what that tells us is that things were beginning to come to life, even from the point at which they crashed in lockdown. I mean, we did have some good themes in our fund, like the great outdoors, that started to play early, but there was some life. Then at the beginning of September, you have the peak in the bond market. And so that is really the relative top for the large cap, which I'm going to argue is a top for the ages. And then, so they start to underperform. That's where you see the dark blue line, which is in the lead, with the stay-at-home stocks going through the roof. On the September blow-off, bond market blow-off, SoftBank gets caught. That's their top, and they then are underperforming. And then on November the 3rd, November the 9th, November the 3rd, the election. That's pretty good. That's pretty good for small and value, but the market doesn't quite realize it at the time because of all the smoke going on around that. But what does blow things away is the vaccine announcement on the 9th of November, which is manifestly good for small cap. And then we just lift because, for instance, our little banks, which have basically done a fascinating chart pattern of an L shape, in that they've gone completely down like a stone, and then they've just gone sideways along the bottom. It was completely appalling, even though they were clearly not going to go bust. It clearly wasn't 2008 anymore. Suddenly, when the vaccine's announced, there's suddenly the penny drops, and everything like that, small stocks just lift. And that's the main beneficiary. And to a certain extent, value stocks are helped by that as well. And so that's where we soon go above them. And it's just pulled away ever since. Now, I just make the point that we've got 120, 130 stocks in that portfolio. So to get to where we are is not us being clever. If you get 130 stocks to go to whatever your statistic was, whatever it is, one in the IA or whatever, it's, if you've got 130 stocks, that means you're in the right place. If you've got 10 stocks and you do it, you're being clever with your 10 stocks. So the fact is, we are thematically in the right place. It's not so much to do with us. It's the market has come to us in a big way, and that's what we would expect, really. Small and value are the main beneficiaries of what is happening right now.
I think it's important to point out here that we'll touch later, but we don't right now, but we'll touch later on why we're not at the top yet. We haven't, there's far to go with this strategy. So we'll come to that later, but just a sort of heads up there. So if we move on to look at value, Richards, this chart again, the sort of logarithmic scale doesn't do it justice. But again, if you put $1 in a value strategy in 1927, it's worth $51,000 today, and growth shy of 3,000. So, Richard, why value?
Well, it's better than small cap, isn't it? 51.3 is quite a win. Again, value was the other main factor discovered by Fama and French. Once we've worked it out, we make up stories about why value. But unlike with small cap, we can actually say much better why value is a better category, and it's all to do with ourselves in the cognitive dissonance we take to the markets, which means we overvalue growth and we undervalue value. And the way it works with regard to growth stocks is that we believe we can see patterns going out longer than they can, and then longer than they do. We're programmed to on an evolutionary basis. We look for saber-toothed tigers in the long grass. We look for patterns in the sky and call it astrology. And in the stock markets, we look to the Japanese and use candlesticks for our charts. But it's all the same thing. It's trying to see patterns. And on the same basis, you're looking for a pattern, and you think you can see a pattern that a growth stock is going to keep on growing. But what is proven forever is that growth reverts to the mean quicker than people expect. And so the way you value a growth stock is you just look at the XX growth over the corporate growth rate, and you compare that with the interest rate, and then you can get a PE to put on it. The failure of that valuation method is that people put on a rate of growth for too long. So you can justify all these big stocks valuation, which they're huge PEs, but there is a presumption of growth going on longer than it tends to. So they revert to the mean PE quicker than people expect, while at the same time, value stocks, which are one definition of value would be that they have a price earnings ratio less than the market, they can do a couple of things to surprise. And the thing they can do most to surprise is that they could start growing again. They could suddenly start to, even if we just grow at the same rate as corporate America, if they just started doing the normal thing, suddenly they become turnaround stocks. They might even become growth stocks again. But when they're valued as a value proposition, that is not factored in. So again, the cognitive dissonance is that their growth could also revert to the mean quicker than expected. And we'll just give you a simple example of this. Very briefly, car company Tesla software company, goes to the biggest, most wealthy person in the world, Elon Musk. The worst couple of disasters going into the early phases of lockdown were Ford and Exxon, but Ford was the biggest company. Henry Ford was the richest person in the world in the 1920s, and Rockefeller was when Exxon was Standard Oil before the First World War. And yet they're the most dreadful examples of value stocks that no one would look at. So it's an example that it all goes around. And now, of course, just a year later, that they've both become turnaround plays and have been shooting up in the last few months. But its perception changes more quickly than we think. And that was also something that wasn't known. It certainly wasn't known in economics. The whole idea of how we are ruled by our cognitive biases. So one of the main cognitive biases, for instance, quite apart from whatever I've said, is anchoring, which is whereby we overweight more recent information. And therefore, with the fantastic news coming out from all these huge growth stocks, we're anchored in the expectation that will continue, and we weight it too highly.
Yeah. Yeah, I'll move on. Yeah, that's great. I'll just move on here. So this chart here goes back to 1978, and this is not a sort of selective data or anything. This is just where the data starts with the Russell 2000 for us. So And still from this more recent date, value outperforms, and it encompasses the emergence of the FANGs and the tech stocks later on as well. Notably on here, the Russell 2000 value element has achieved a high return, but with a lower standard deviation. Could you just run us through that, Richard?
Yeah, well, we're looking at the same type of chart again. We're just looking at it on a shorter term basis. The standard deviation is something that investors value, and it helps with the Sharpe ratios, which is the amount of value, basically the attractiveness of an investment proposition. The lower the standard deviation, the better, because it's a more dependable investment. In other words, you can sleep at nights with it. One of the fascinating backtesting statistics that my prop books have discovered was that low beta is an outperforming asset class. So as the boring stocks, I suppose it shouldn't come as a surprise, do better in the long term. We've got a big weighting in our fund, for instance, in community banks. They're not only the cheapest value sector in the market. I was originally attracted to them because they're one of the lowest. I started looking at them after the last financial crash. I was just attracted to them because not only were they so cheap, but they had about the lowest beta in the market. So here we had an outperforming class with low beta, and again, not only is value an outperforming asset class, but you can see here that it has in the last they're showing a lower standard deviation, which is another attractive feature of value, and that's implicitly that's intuitively correct. If you think about these stocks, which are rockets, they just shoot up and if something goes wrong, they shoot down again. You can just feel that they have this much greater volatility, and yes, that's another reason to like value. Now you might not think that, given that when an economic crisis hits, as it has done twice in the lifetime of most investors in 2008 and last year, and value will just crater. And so it's hard to imagine that it's a lower beta group, hard to imagine it's an outperforming group after you've lived through what happened in 2008 and 2020. But the fascinating thing is that those figures still hold true. So that's why it's worth just looking at them and reminding ourselves, just because we've come out of a period where value did exceptionally badly, which is early 2020.
Yeah. So if I move on to this chart here, this is just shows the value and growth elements of the S&P 500 since the launch date of Richard's fund, 2010. If we were to put the fund's performance on here, it would be 431%, so just shy of growth, which is quite impressive, I think, considering the value approach Richard takes. So if we could, Richard, could you just talk us through why value has underperformed in this time frame here in the last 10, 11 years?
Absolutely. Well, the first thing to really hammer home here is that these charts are now upside down. We've seen all these charts about value and small doing so much better on these log scales over the long term. And now we've got a very slight fudge here because this is a linear scale. So in fact, growth isn't doing that much better in the longer scale of, well, it's doing, sort of twice as well, but in the scale of the great rewards that we are looking for, losing just, a couple of 100% behind, we can deal with that. As Will very kindly said, we have managed to keep up with some ducking and weaving, partly because we have been below the level of the S&P value. We can do some stuff that they can't in the smaller stocks. But what we're looking at here is the outperformance of the big cap growth, and there's two major reasons. The first reason is the PE multiple expansion, as the bonds have gone ever upwards to record low interest rates. And so again, what PE should we put on a growth stock? All we need to know is the growth rate for how long it goes and the bond market yield, which has been going down forever. And so it's just a simple multiple expansion. But to add a bit of sauce to this, we've also had the ability of the larger stocks, which weigh very heavily in this index, to accrete monopoly power without being checked over this period. So that has helped them quite a lot. So that's why you get a particular strong gap. I mean, this graph goes back to the launch of our fund, which is pretty, but it actually, growth has been outperforming since 2006 for its longest ever outperforming run. It's had a nearly 15-year run of outperformance against value, which we have never seen before. And that goes beyond monopoly legislation. That's interest rates going to all-time lows.
If I move us on there, Richard, we'll look at the interest rate cycle here. And I mean, this chart shows 10-year Treasury bond yields over, I think it's greater than 100 years on here. And it shows the last two cycles. Could you just run us through this chart, please?
Well, it looks quite amazing, doesn't it? I mean, it just looks like it's going into the ground. But it's reasonable to say that there's a Kondratiev cycle that goes on in interest rates. Kondratiev thought of the long-term cycle was 50 years, but since then, life expectancy has increased. So it really looks more like an 80-year cycle. The argument being that when something passes out of memory, we're able to repeat it. So when we remember the mistake we make, we can't repeat it because we know what to do. But when we forget, we can do it again. So the previous cycle bottoms with the end of the Second World War, after the austerity before then and the build up to war. By analogy, we are at that point again now. What then happens is you get the Marshall Plan, you get people throwing money in 1946, fiscal policy, Keynes intellectually dominant, throwing money at the situation, but it takes a long time for inflation to build up. In fact, inflation doesn't even come on the radar until the late 1960s. And then OPEC starts in 1970, puts the price up in 1973. And you get a peak at the time that Reagan is elected, and his chairman of the Federal Reserve, Volcker, says, we will stop inflation. It doesn't matter what it does to the economy. We will put interest rates up to stop it. It creates the recession of 1982 and 1983, a big recession, and because you have high real interest rates, and it chokes off the inflation, and then monetary policy becomes predominant for the next 40 years. And then when Biden is elected, the reverse happens, and the reverse has just happened, whereby Biden's Fed wants to start the economy, no matter what it does to inflation. So it's the opposite policy of Volcker, who wanted to use monetary policy to kill inflation. Now we've got a policy where we want to use fiscal policy to return to full employment, like we had in 1946. And the good news about that, for the people that are worried about inflation, is that the inflation, as you can see there, takes a long time to build up. In the short term, you may well get some short-term bottlenecks, as we're seeing now with a big run-up in commodity prices. But I'm sorry, I'm digressing. But they're short-term in nature. So there's no really structural problems with inflation to come for a long time.
I move on to the next one, Richard, because we look here. Sorry.
Go on.
So I was just going to say, these sort of 5 charts here, they show how value and growth have performed during the last cycle you're referring to. They show that when yields are falling, growth outperforms, and when yields are sort of stable or rising, then value outperforms. And they started doing just that from 1945 to sort of 1980, really. Value outperformed. So, Richard, where in the cycle are we right now, if you were to use these charts as a sort of example of the last cycle? Where are we now?
Okay, so the 1930s had high real interest rates. That was the end of the previous cycle. So that was the low. By analogy, I think we'll all be happy to hear we're not in the 1970s. We're in the 1940s. As it turns, they had the Marshall Plan. We have Biden's infrastructure plan. Let's not minimize this. His infrastructure plan is absolutely huge. So he's got one plan for the amounts of money is staggering. There's a 1.9 trillion and a 2.3 trillion number of roads and bridges to be built over the next 8 years. Was it 20,000 miles of roads, 10,000 bridges in 8 years? This is huge. It's a bigger start than either FDR or with his New Deal. It's a bigger start than LBJ and his Great Society. It's big. And also, for people that say, no, those guys commanded both houses, and so they could get through what they like. Biden's got thinner majorities. It doesn't matter. There's a will of the people here to get something done under COVID. So he's got just as much power as those people had, and he's using it. So therefore, by analogy, we're in the 1940s. We're in a sweet spot for value, and it should go on for a long time.
Moving on to this chart here, if you could just in the interest of time, just touch on it really. It shows the 10-year Treasury yield since the start of last year, 2020, through the pandemic and to present. And yeah, if you could just touch on this one, Richard. So where do we?
You see that last chart pointing into the ground, and over more than 100 years, and you know by the way that it goes back from to the foundation of the Bank of England and goodness knows what else. We've never seen anything like it before. You're tempted to say, what next? And what does happen next, of course, is you get this extraordinary bottom here. Crash. That is classic charting, isn't it? Crash down, reflex rally, retest in the third quarter. That's that September peak we were talking about earlier. That's the real low, as it retests the March crash low, and that you are seeing is a 40-year turning point. I don't think, you see, that's not even a controversial thing to say, but to say, well, that's just to say that's a 40-year turning point. That's a market turning after a 40-year bull market, and you say, well, yes, it is, isn't it? No one's going to sensibly argue that interest rates are going to go lower. But just by saying that, it's a really major statement. It's saying that the whole system of the last 40 years for the markets has just changed. Yeah, thank you. So if we move on now to our last sort of section of why now, perhaps, Richard, you could just run us through this slide here. We've put together a few sort of summary points on each of our 3 sections. Could you take us through it from US small cap and value, please? Yeah, I mean, why now? Is that now is the time for small cap and value because they've never been in such an extreme place. In the US, where we are, you've got just to read out the slide, you've got commitment to full employment from Biden, which we've just talked about. You've got big numbers forecast for economic recovery next year. The big brokers are forecasting about 6.6% GNP growth. This is the biggest growth for decades. I mean, all the time when you're using monetary policy, towards the end of using monetary policy, you are going to get subnormal growth. It's the perennial problem that Keynes talked about of pushing on a piece of string. You take the rates down to naught, nothing happens. Well, then what do you do? Take them below naught, but you still don't get the growth that you want. You don't get it until you get direct action. And the Americans have admitted this. They're following what they call MMT, which is modern monetary theory is absolutely not modern at all. It's just Keynesianism with the twist of seigniorage on top, which is the ability to get benefit from having your own currency. So Keynesianism is back, dressed up in a way the Americans can say that they invented it. And they have this commitment to spend, to deficit finance until things get better. And that is the perfect for small cap and value. If you imagine, it's perfect for value because infrastructure spending is value. Value essentially lives in the industrial sectors. That's where a lot of the value stocks are. And all these companies that are going to be doing this, that are going to be receiving the benefits of, or the consequences of this stimulus package, whether it feeds through to people or whether it goes into actual spending on building the schools and hospitals, that's value. Where the US, well, that's where the small cap value is. I mean, that's where the opportunity is. You can't ignore it. Why small cap? Coming back from a long way down, it certainly is. Small cap value went to the biggest discount relative to large cap growth since 1904, according to an article by the FT. And it managed to do that by last September. It hasn't come back that much. If you consider our chart of how we've done a bit better as a sort of proxy for that's really not very far considering how far down it's been. And that's still manifested by the fact that the PE ratios are small compared to the large cap. But the rather exciting thing is as this spending materializes, you're going to get the phenomenon of PE multiple expansion. And also that thing we talked about earlier, that some value stocks are going to be reconsidered as growth stocks as they start to grow their earnings. Vaccines are better for small cap than value because vaccines cover the reopening plays, all the various great outdoors, going out to play again stuff, which are typically found in small cap stocks. But the overall thing, apart from getting excited about why now, and basically because the economy is coming back, which is the best for this class of stock, is that the relationship that we talked about to what value is doing when yields are rising, as we saw in the slides of previous decades, that's all with us now, and it's a turn in the interest rate cycle is the overwhelming thing that will push people from growth stocks to value stocks that they have long ago forgotten about, as they need to get out of growth stocks because of interest rate rises.
And we'll come on to that in just a moment, actually. But just before we do, and I know there's a few people have been emailing in and using the Q&A box here. They want to hear you just talk a little deeper about particularly in the US and Biden as well, and what his policies really mean. You have already touched on it, but and also just a couple of minutes on this one, Richard, if you don't mind. So, for example,
the idea here is that Biden's able to implement in that he knows how to pull the levers. Which if you look at the last three Democratic administrations, Obama, Clinton, Carter, they were all completely new and starry-eyed. They didn't know how the system works. They couldn't get it going. Biden knows exactly how it works, and he doesn't care. He's old. He's going to pull those levers, just like Reagan did. That last point, Trump said he'd do this, but all Trump actually did was he put tariffs on China, and he cut the corporate tax rate. What he said he'd do, which was to help his base, he didn't do, which was this infrastructure spending. So we had another 4 years of monetary policy. It was quite interesting that when Trump got elected in November 2016, we had what was called the Trump bump, and value stocks just lifted for a couple of months on the prospect of this spending that never came. And that in a way that it was Trump's failure to follow through on that really led to this extraordinary position of monetary policy just being used and used and used, so you have a third of sovereign debt around the world having negative interest rates at the low, and although everyone knows this is ridiculous, there doesn't seem any way out of it. And what it needs is a determined fiscal action, which is what we have now, to get rid of all those paradoxes whereby it's easier to turn your company into a pile of debt and not pay and buy back the stock in order to not pay the dividend. The whole thing's messed up at zero rates. So that's all gone away now. And so the why now is really because the moment is here for this type of stock. I know you might think it's something of a paradox that we say on the one hand, the US is 55% of the whole world, and yet you must invest in the US now. That's because the US has so many different parts to it. I'm not saying you must invest in the big mega caps now. They will have to grow into their multiples. What that means is they go sideways, they grow their earnings, and yet their PE multiples steadily come down. So as the stocks go sideways and the earnings come in, we've seen that before in the 1960s, Tom. But there's so many different types of investment opportunity of classes of stock in the US that we're not bothered what weighting the US is in the whole world market. We are in a very small part of the US here, the small cap and value, just because it's been compressed by this 14 years of underperformance. So why now for US small and value. That's in particular what will benefit from the change in interest rates, the change in government policy.
Yeah, fantastic. Thank you, Richard. And then I suppose we just wanted to. Why would you encourage some people? Some people I speak to on the phones and all that will only hold one US large cap fund, and it'll be a large cap, and it just will focus on larger companies, and there isn't really consideration for anything smaller. And could you, as the title suggests, what reasons would you question large cap and growth in particular?
Well, as we discussed, the interest rates will hurt them. But just look at that last point on monopoly power. Monopoly legislation set a long time ago. So for many years, if you're a big company in the tech sector and someone's got a good idea, you just buy that company out if it threatens you. All that is being challenged now. So Biden will put in some monopoly thing. Also, their ability to pay less taxes than people think they should is also going to be challenged. So the clouds are darkening anyway, even if we didn't have this huge cycle change. So I'm not saying to divest them, but I'm just saying that they're a very different investment proposition to what we've got, and you might and the tailwinds that they've had, for these last 15 years or so, ever since 2004, 2005, those tailwinds are well, one is turning against them into a headwind, and the other one is fizzling out. The monopoly power thing they've got away with is fizzling out. And that's quite simple because these guys are well ahead of Congress and so on, but slowly but surely the wheels of government catch up with them. And there's more determination now to hold them to account. And again, the funny thing is, I'm not saying anything controversial. It's not as though this is some sort of conjecture on my part. It's happening.
Yeah, absolutely. And so,
look at Nvidia gets challenged for buying ARM. Everything's not so easy as they thought it would be. Sorry, go on.
No, I was just going to say, just before we touch on the sort of the key points that we've covered in this presentation, I just wanted to just give a quick summary of your fund, Richard, to those listening, and just a very sort of basic level, so Rich has got about 120 stocks in the portfolio, vary between 80 and 120 or so, and it's focusing on smaller micro-cap companies, like I say, in the value end of the US. Median market cap about $364 million. Again, far lower than any of the funds really in the peer group. Sits in the IA North America sector. It's number 1 over 1 year at the moment. And it's got incredibly low correlation to all other funds in there. So the fund's a daily dealing fund. It's on all the major platforms apart from Old Mutual Wealth and Fidelity Funds Network, which we are working on onboarding. That will come soon. Richard, you've got a couple of minutes if you just wanted to add a little bit about your investment approach, perhaps your thematic way of looking into how you pick companies.
Well, you touched on earlier, Will, about how we've managed to keep up in the last 10 years of pain and keep up with the market, and that's because we have we've been able to do a thematic approach to various things that are changing in American society based on demographics. And that did come our way a lot quicker in lockdown, when some of the people said that lockdown made everything that was going to happen go quicker. And certainly some of our themes, like an appreciation of the way people appreciate the great outdoors more, came rushing to us. So we use that as an add-on to all the data that here's prop number 2, all the data that these have found out, which we use fully. I mean, when we first started, I had this extraordinary experience of finding that whatever we bought, I would find that the fund that used to be called the Black Box was also in there with us. That's Renaissance Capital, which had such a successful track record using all this quant stuff that they wouldn't let anyone invest in it, and that's why Jim Simmons became a multi-billionaire and so on, because he did, because it was his fund. And I've eventually found out that these black boxes of these hedge funds, which were also secret, were just doing exactly the same as us. So we're just using this data, which was the back-tested numbers. So we do all that. So we've got all that stuff. I know what they're all on about. But we're also trying to use our own themes to try and get ahead of really to push on an open door, because even if I've judged the company badly, if the business is coming its way, it may just be all right. And so we have a thematic approach to investment, and that's why we have so many odd sectors.
Fantastic. So let's just do a quick recap of what we've just covered today. Perhaps, Richard, I just would hand these over to you just to quickly sort of summarize. So first one about the US, it's corporate governance and various bits.
Okay, very quickly then.
Just quickly, yeah, we've
got. US is the best place because it's got the governance. That's why it's happened, and that's why you can have confidence it'll go on happening. All the siren voices taking you off the fast growth markets, don't believe it. We've been seeing that. We've been hearing them forever. Secondly, we've got this extraordinary statistic. I'm very lucky to be invited onto your call at this time because I can produce all this hyperbole, and it's true. I mean, here we are at a 100-year turning point. It's a wonderful thing. Even though the overall US market is expensive, well, it's expensive because you see, the funny thing is, big cap is the underperforming asset class, but it's been the outperforming asset class, which is why for 20 years you have the largest cap ever achieved is Exxon in the 1990s at 300 million, 350 million or so on. And suddenly, boom, you get all these companies at the same time worth more than $1 trillion each. It's because you have this huge run in all the records are just absolutely taken away. You have this huge run in these mega caps, and they go to these huge multiples, and that's what makes the market expensive, because they have such a strong weighting in the index. So if you have a company, you know what these companies are. I mean, you look at the multiple of Tesla, you look at the valuation of Tesla, which is 700 billion, and you consider what that does to the PE of the market, and these are big effects. All our stocks are not. I mean, we've got banks growing at 15%, which are on 7 times earnings, 7 times trailing earnings, and that's trailing after the difficult year they've just had. It's a completely different world. I've argued that Biden, who probably hasn't impressed you, is going to be a historic figure. And he's going to be a historic figure not because he's great, but because of his position of what he's what we call a lucky president. Clinton was unlucky. He had nothing to do. There was no crisis. Everything was great. Biden's coming when you can do anything to solve it. And he will therefore do that and be popular because of it. Prospective strong economic growth. Yet we've got the strongest growth coming up, as we've discussed. Huge growth coming up. And as the fiscal spending comes through and they surprise themselves by not getting inflation, so they carry on spending, which is this multi-decade thing that we've been talking about. So the fiscal spending keeps on going. That's why you've got the small cap value relative to growth. Now, it's not just me. It's been picked up by one or two of the big strategists, just recently been picked up. They're saying that small cap value runs for 8 or 9 years now. But you see, they can say what they like. Because when you can use those charts, you can argue that it's a big, big term. So this is not a trading move. And of course, it'll go back and forth. At the moment, in April, we've had bad COVID news, so it's been going back to big cap a bit.
Richard, I'm just going to jump in there, given that we've gone a couple of minutes over. So I just want to wrap it up. It's basically, if your CPDs, to all our sort of listeners, the CPD certificates will be with you within 7 days. And one of our team will call or get in touch. We'd love to hear your sort of feedback on everything Richard and I have been talking about today. I know a lot of you have been sort of expressing interest in meeting Richard on a sort of one-to-one Zoom afterwards. We can absolutely sort that out. So we'll be in touch. And to those who have asked some questions on our Q&A that we didn't quite get round to, we'll be in touch. Yeah.
I'm sorry for suppressing questions by just going on and on. And we will get them answered. I'm sorry.
We will get them answered. That's
bad behaviour.
Yeah.
Good way of getting out of them, but bad behaviour.
So yeah, thanks very much, everyone, for your time today. Thank you, Richard, as well, for coming on. And yeah, I hope you all have a nice afternoon.
Thank you very much, everyone. Thank you, Will.
Thanks.
Goodbye.